Welcome to Freedonomix. We're exploring a question almost every investor asks at some point. Is now the right time to invest? But beneath that question is often something deeper: uncertainty, hesitation, and the fear of getting it wrong. In this episode, Lynn, who's a senior financial advisor with us at IWP, joins us to unpack why investing isn't really about finding the perfect moment to invest, but about having the right plan, the right mindset, and the confidence to take a long-term view. Hi, Lynn.
Hi, Cam.
How are you?
I'm very good, thank you.
That's great. It's great to have you here. I've been doing this for 25 plus years or something. And the amount, I reckon every client I speak to says, is now the right time to invest? Is it a good time to invest? I should have done it a month ago. Should have done it next at 6 months' time. Is now the right time? And you've taken on the courageous article that is to answer this question.
This is the reason why I picked this article because, as you know, we got asked this question a lot. And especially recently, I noticed that. And to be honest, I was thinking if I can just write an article about it or do a podcast about it, maybe I can just refer the client to this. And
you try to save yourself some time.
Because, to be honest, we can have a half an hour or 1 hour conversation. Of course, we probably won't spend that long in this video and podcast, but the reality is it's a complex situation.
It is.
And I was thinking if we can share some high-level thinking out there and help clients to have some rough idea or just be prepared for what's our usual approach, that probably would be very beneficial.
Yeah. And I think it goes to our approach, I think goes to a little bit, and I'll leave you some space to talk about it in a second, but it goes to a little bit about how we actually approach our clients anyway, which is to get a deep understanding of their dreams, their aspirations, their intentions, understand what they think, what their values are, what their deep motivators are, and then we can help them solve their broader problems, one of which usually starts with, is now a good time. So, Lynn, would you like to take us through what our approach is?
Yeah, more than happy to. As you point out, when clients, when they come to ask this question, usually they have some idea in their mind that potentially we can share our view on the market movement, and we'll give them some commentary about whether the market would go up or down. Is the market overpriced right now? This is usually what they expect when they ask us this question, is now the right time to invest? They're expecting how we're going to answer it from a market perspective. And the way we approach this question would be a bit different. Usually not from the market perspective, it's more about their personal individual circumstances. We would address this question whether it's the right time to invest, not based on the market condition, but mainly based on the stage of life you're in and your personal goals, dreams, and aspiration. And there's lots of factors we need to take into account. So very often there's no straightforward yes or no answer. The general answer would be it depends, but more likely than not, the answer would be yes, it's a good time to invest, but it doesn't mean you just go all in at the same time without any proper plan and preparation for it.
Yeah.
So that's where I would like to dive deeper, not just to answer this question, but also help clients to understand how to better frame questions they're thinking and making sure they're asking questions that they are more appropriate to their situation, that are actually give them a better chance of achieving their goals rather than a simple market entry question.
Yeah. Look, I think that's a really good response, because I know we just think through some client examples for a second. You know, a client might come to us and they might have sold an investment property, and maybe there's, I don't know, say $1 million in cash as a result of that, and they may be fully invested in their superannuation and might have a high growth investment strategy in their superannuation. And then we do an assessment of that client and we work through that. Actually, we probably think in terms of the amount of risk that the client needs to take, maybe they should be balanced. They don't need to take a high growth risk profile level of risk. And so in that case, and it's good to work through specific examples. In that case, how would we approach that, do you think?
It will depend on lots of factors. I think that's a very, very good example to help us visualize what does it mean when we say it depends. It's not.
Yeah.
There will be lots of factors we need to consider. How far away they are to retirement, what's their living expenses going to be like, how their transition to retirement plan going to look like, and how much asset or wealth they currently have. Is that in super, outside super? What's the current asset allocation structure, their needs for capital, liquidity, and what's the return level they should be aiming for, and what's their comfortable level for short-term or long-term market volatility. So there's so many factors at play, and that's a very good example. If we make it even more specific, if they have 1 million cash available and their superannuation balance is relatively modest, and they are, let's say, less than 5 years away to retirement, we probably will make sure they have enough liquidity to cover their medium-term living expenses.
Yeah, and the other thing that I find that clients tend to do is they anchor themselves to a retirement date.
Yeah.
So they'll say things like, I'm retiring in 12 months, so I need to make sure that all of my super is really safe.
Yeah.
And I counter that with, actually, I think you're investing for the remainder of your life, and perhaps if there's enough money for the next generation as well. So anchoring yourself to one date, it just seems to me to be something that's very common. People do that all the time. Yeah.
That's why time frame is so important.
Yeah,
ultimately, the question is now the right time to invest, is what's the plan is.
That's right.
Yeah.
What's our long-term plan?
Yeah.
What's our medium-term plan?
Exactly.
Do we have enough money set aside to make sure if something happens, we've got 3 to 5 years worth of living expenses set aside if we're heading into that retirement phase. Unpacking all of that is the most important thing. So, so once as financial advisors, let's imagine we've gone through that process with someone. What do we then do? So, because we still need to answer that question, but we've got tools like dollar cost averaging that we can use, and that sort of thing. That sort of, if markets are a little bit rocky and clients are feeling a little bit edgy, we don't necessarily need to put their $1 million into the market.
Yeah, that's definitely true. There's another probably more relatable question, a scenario would be someone, they have a relatively long investment time horizon. They are, for example, in their 40s or even younger, and they want to plan for the long term, but they still have this expectation that entering into the market at the right time would make some impact to the return. And which is a reasonable question, but the challenge is it's really, really hard to predict what the market would do.
Hang on, Lynn. I'm going to have to stop you there.
Yeah.
So what I'm hearing you say is that it's really hard to predict the future. In fact, I would counter that with, it's impossible, funnily enough, to predict the future. Unless you're Nostradamus.
You never know.
Depending
on your life philosophy.
You never know. Sure,
there might be a time traveler out there.
Maybe, that's possible.
So I don't have the skill. And if anyone says they have such skill, I would be very suspicious of it. So it is almost impossible, if it's possible
Let's
at all.
just say impossible.
It's impossible to predict the future. But it is possible to have a structured plan to make sure you are prepared regardless what's happening in the future. So why do we make such important decision based on something we cannot reliably predict or reliably take advantage of? Instead, we should actually focusing on what we can control. And actually, there's no shortage of evidence out there based on historic data to compare different philosophy. There are certain people historically has been trying to time the market, and there are also people or investors, they have been using a very disciplined like a very disciplined investment approach,
Yeah.
like the way we do. Although we say we cannot predict the future, but we do have enough historic data to tell us what the future may look like based on certain behavior, certain pattern, certain
Yeah.
philosophy. And this is how we approach our portfolio and what we believe in. We are mainly driven by evidence, and the historic evidence has been showing that time in the market is more important than time in the market.
Yeah, yeah, that's right. I think is the bigger risk for most people short-term volatility or never quite getting started because they're waiting for the perfect moment.
Oh, this happens all the time. This comes down to it's really hard to know when is the right time to enter the market, depending on what you are fearful of.
Yeah.
There's always reason why people do not want to invest if this is your starting point. For example, if the market is too high, people may think it's overpriced.
Yep.
It's more likely to come down in the future, so I probably should wait for better opportunity. Or if the market is falling, they're probably thinking, all right, there's too much uncertainty out there. I don't want to start investing right now. So
Yeah.
if we start from that mindset, you will never start investing ever because there's always something to convince you not to do it.
Yep.
And the reality of not investing at all, I think is no secret. Anyone probably, even people who are not sure about investing timing would know the long-term performance or outcome of not investing at all. It's way worse than doing something more proactive.
Yeah. I think what happens is when people always have a short-term mindset,
Yeah.
always. And so I think what happens is you feel like you've just gone and done something, right? So you've gone through the process, you met with the financial advisor, you've been given some good advice, you implement the advice, and then when we see it, because we see when people check their portfolios and stuff, people, when they first start, they check a lot more than they're checking after they're feeling more comfortable and they're trusting the process, etc. But then when you extrapolate out timeframes,
Yeah.
and you could pull a chart that starts here and goes like that, further and further and further, we always say, well, investment markets are not linear, but the further you pull that chart out,
Yeah.
the longer the time frame, it almost starts to look a bit linear. It's just looking like that. It's just going straight up every year by your 8 or your 10% or whatever number it is, and it's incredible. But in the short term, there is short-term volatility, and I think being able to manage your emotions when there is short-term volatility is just so incredibly important. And I say this all the time, and people get sick of me saying it, but when you're one of the reasons why why people need advisors is because when you're emotionally attached to something, you don't make clear, concise, considered decisions.
Yep.
You make decisions based on how I feel. And at the moment, if I've invested money and the market's fallen 12% because Donald Trump's invaded Iran, I feel anxious.
Yep.
So the feeling, people have a flight or what is it? A flight or a freeze or a flight response. When they're feeling anxious, and subsequently that can cause people to sell out of the market if they're going alone. So I think when you consider that and you extrapolate out the time frame is what is your friend when you're investing money in anything, as opposed to worrying about the short-term volatility. It's just there's no control in that.
Yeah, I completely agree with that. And that's exactly what I like to do with our clients as
Yeah.
well. Like show them the long-term chart, 10 years, 20 years, 50 years. It becomes really obvious. The current condition is just a small noise in the bigger picture. And I actually have an interesting example on this topic when
Great.
you mentioned that people who are being very cautious with investing. Recently, we have a new client coming to us, and they have saved a significant amount of cash, like more than $500,000, through different resources, like working income, some
Yep.
sale of equities, and also some early inheritance. They have more than $500,000 saved up in cash since COVID. And they have been really, really careful ever since the start of the COVID. And they think they have been pretty lucky for
Yep.
not investing through that period after seeing what the market has done in early 2020s. and they had been putting all those money into cash and term deposit, and they were in their early 50s at the time. And because they want to retire in 10 years' time, so they want to be really, really cautious.
Yeah.
And fast forward 6 years later, when they come to see us,
Yeah.
they're $500,000 are still $500,000 in cash.
Yeah.
And they've been feeling grateful that they haven't lost any capital.
Yeah.
However, the other side of the story is the huge opportunity cost they have lost. The market has increased more than 100% since 2020. If they had invested the money early on, they would have not $500,000, close to over 1 million right now.
Yeah.
And now think about the life stage they're in right now.
Yeah.
5 or 6 years ago, they're in their early 50s.
Yeah.
Now they're closer to 60 rather than 50. It's never too late, but not coming to see us early
Yeah.
make such a huge impact to the retirement.
Yeah.
And I think that's a pretty good example. And they were trying to do the best thing they could with
Yeah.
their knowledge, and they were trying to be really, really careful. And this comes down to what you mentioned about there's a fear about losing money, and they feel uncomfortable with that. But I may also ask question like, of course we understand it's never comfortable to see short-term market volatility. However, if I can show you the long-term picture of not investing, if you know that there's a high chance that you may have to downgrade your house, reducing living expenses,
That's right.
and your money gonna run out in the long term, that is naturally very uncomfortable as well.
Yeah.
If you compare those two, which one is scarier?
Yeah.
The high chance of you running out of
Yeah.
money, or the market up and down on paper?
Yeah. I think that's really well explained, and I think we see clients like that all the time, and that's okay too, right? Because people are doing their best to put themselves in a position where they can live out their dreams, retire, whatever that looks like. This goes back to my point about managing your own behaviour.
Yeah.
When you manage your own behaviour and you're emotionally attached to your money, because people are, because people have spent 10, 15, 20, 30, 40 years building up, gone through lots of life things, horrible things have happened, good things have happened, there's lots of emotion in that. And then because you're emotionally attached to it, you cannot make clear decisions.
Yeah.
And so this is why we
Yeah.
have a business, this is why you
Yeah.
have clients, this is why I have clients. So I think that's a really good point. Well done. Yeah. Finally, is there any final things you might like to add?
Mindful of the time. I just
Yeah.
quickly commented on that I'm quite mindful of the amount of opinion and noise
Yeah.
or internet commentator out there.
Yeah.
Some of them may agree what I was saying. Some of them may hold a different view. And sometimes we do have clients, they come to us with certain things they heard from others.
Yeah.
And usually the way I explain to them is, it's not about who's right and who's wrong. It's more about how we interpret the message and what's their investment philosophy, what's their plan, and how do we actually relate what others are saying to your situation.
Yeah.
I'll just share a specific example. And sometimes clients come to see us using Warren Buffett as an example.
Yeah.
And as, if not the best investor out there. And we know that in recent time, he has been holding more cash than what he has been doing in the past. We often, not too often, sometimes we have clients coming to see us and asking this question. If Warren Buffett is being very cautious with deploying his cash, like, why do you think it's the right time to invest right now? They're not wrong, but the key answer to this question is we need to understand the difference in Warren Buffett's investment philosophy to ours, and how do we actually use his philosophy to your situation. I just quick answer to that is certain investors, they are more active value type investors. They are proactively seeking out individual companies to invest. When there's no good individual company to invest, they would rather hold more money in cash. And especially when we're talking about someone like Warren Buffett at that level of wealth and scale, it will be much harder for him to find a really good company to buy without fundamentally changing the price.
Yeah.
That's why it's become harder and harder for him to deploy his cash over time. But our philosophy is fundamentally different. Our approach is low-cost, diversified, passive investment. And so that's why it's not about timing the market. For us, as long as you are structurally ready and also you're ready in life in general, it is always a good time to invest with some detailed plan tailored for you.
Detailed plans in place.
Yeah.
Look, Lynn, thank you so much for firstly writing the article and taking that one on because we do get asked that question almost every day. And then secondly, thanks for your time now. It's been great to hear your thoughts and so thank you.
Thank you for having me.
Thanks everyone. See you soon.